If investment is a journey, then asset allocation is its guiding star. Where you put your investments has a huge impact on their success. In fact, the vast majority of your returns can come down to these choices. This is How to Invest by Julius Baer. In this episode, we are looking at asset allocation. And the lesson here is pretty simple. Don't put all your eggs in one basket. Now, if only we could end the episode here. Certainly, this is clearly a step in the right direction, but there is a lot more to it. So let's dig deeper. So you've decided on your investment objective. If you don't know what I'm talking about, please go back and watch parts 1 and 2 of this series. This objective or reason for investing will really help you work out your risk profile. That's the risks that you're willing and able to take. Remember, this is one of the most important decisions you'll ever make, at least when it comes to finances, because understanding your willingness and ability to take risk ultimately impacts the possible returns on your portfolio, that is, your collection of investments. But before we go any further into where to put your cash or how to allocate your assets, we still need to talk about those eggs in a basket. Because one of the very best ways to protect those assets for the longer term is to diversify. The reasons why diversification is so important is down to another type of risk. Not the same risk as your own appetite for risk, but rather the events that can happen in life that are really out of your hands but could impact your investments. A risk in this regard doesn't have to be avoided, just managed. So think of them in 2 categories: systematic risks and specific risks. Bear with me for this for a moment. Systematic risks are things like political turbulence, war, natural disasters. They are things that happen to the whole market. They're unpredictable for the most part, and managing this kind of risk can only be done by, well, not much actually. Not investing at all is one way, but putting all your wealth into a bank account isn't going to grow that wealth, future-proof it, or protect it from inflation. More on that in the next episode. And really, if you're watching this video, it isn't something you would really consider. Specific risks, on the other hand, only affect one asset or company or small sector. They're usually things like poor management, financial obligations, or location challenges. And this can be avoided or reduced by, you've guessed it, diversifying your portfolio. But the benefits of diversifying go beyond just reducing risk. It can also help you sleep better at night. You know that feeling when you're putting all your money into one investment and you're constantly checking the stock price or the market news to see if you've made a huge mistake? Yeah, it's not fun. But when you've got a diversified portfolio, you don't have to worry as much about one bad investment tanking your entire portfolio. It's like having a safety net. A balanced portfolio can look something like this. You can see it has a certain exposure to stock markets, bonds, alternative investments like hedge funds, and currencies. And when I say this is a balanced portfolio, it means that I'm in the middle of the road really when it comes to risk. You might be a little more risk on, which means you invest more in the stock market. You might be even more conservative, which might mean you lean more heavily on sure thing investments like government-backed bonds. Every portfolio is different because of your personal preferences and risk appetite. But even if you know you're after a balanced portfolio, how do you know exactly what to invest in? Do you want an active fund or a fund that tracks the market or a direct security? This is where it can get tricky. Do you know all the different ways you can invest on the stock market? Every individual company, every fund or product associated with it? Are you in deep on certain industries or trends? Now, I know the answer here because no one knows that. Sure, there are some people who know more than others and some who have more experience in a certain area than others, but having such a grasp on the world or universe of investing is a full-time job. And this is where delegating can come in pretty handy. You might remember in episode 1 that even Warren Buffett does this. handing over part of your investment portfolio to professionals that work on a particular part of the market or on a specific asset class. This is what Julius Baer calls a core satellite strategy. You have a professional look over the core of your assets, protect that core wealth and grow it. Then you have more freedom, as it were, with your satellite assets. This is where you can get more creative if you wish, invest yourself, pick themes and industries that are of interest to you. But equally, you can also hand over these assets to a professional too, who might look at thematic or tactical investments for this part of your portfolio. Now, if you did want to take on asset allocation yourself, here are 3 tips to get you started. I think it was 90s Britpop sensation Oasis that said, "Don't look back in anger." I'm pretty sure they weren't talking investment strategies here, but it's not bad advice. In fact, you shouldn't look back at all. It's tempting to look at how various asset classes have performed in the past to inform how they might perform in the future. But correlations are very unstable and not very reliable. It's like driving a car forwards while staring in the rearview mirror. You're going to crash. So take past performance with a pinch of salt, and don't get me started on predicting the future. You need to diversify precisely because the future is unknown and very uncertain, even in the best of times. 2, diversify. I know what you're thinking, but Hannah, you've already covered this. Yes, we have, but not only should you diversify across different asset types like stocks and bonds, you also diversify within an asset class. And guess what? This can also help you manage risk and maximize returns. For example, if you invest in stocks, consider diversifying across different sectors and company sizes. If you invest in bonds, consider diversifying across different maturities and qualities. And if you're asking how diverse a diverse portfolio really is, with one investment clearly not being enough, a general rule of thumb is to aim for holding around 20 to 25 positions. This is enough to be diversified without being too much that you can't keep track of them. 3, identify with your investments. Now, I've already given the merits of delegation, but equally, I'm not saying take it all personally. Don't pick your stocks and sit across them every day checking their price. We know from previous episodes that this can lead to making real mistakes. If you're tracking a stock daily, you will be influenced by the daily ups and downs, and really, it's not fun either. While investing shouldn't be emotional, you should have some connection with your investments. At the very least, identify with your investments. Think of it like adopting a puppy. You want to find the right one that fits your lifestyle and personality. So do your research and find investments that align with your values and interests. And if you're still struggling to figure out what those are, take a moment to reflect on what makes you happy in life. Maybe it's traveling, maybe it's supporting sustainable companies, or maybe it's just buying lots of shoes. Hey, there is no judgment here. But once you have a better sense of your values and interests, you'll be able to find investments that make your heart and your bank balance happy. Now, let's look at how you keep your portfolio in good health. Once you've established your investment portfolio, it's important to monitor and rebalance it on a regular basis. This involves reviewing your portfolio from time to time to ensure that it remains in line with your investment goals and risk tolerance. We talked about that at the beginning. Over time, certain assets may outperform others, causing your portfolio to become unbalanced. For example, if your portfolio is allocated 60% to stocks and 40% to bonds, and stocks outperform bonds over a certain period of time, even if you don't change anything, your portfolio may become over-allocated to stocks. This can increase your overall risk and potentially derail your investment goals. To prevent this, it's important to regularly rebalance your portfolio by selling assets that have performed well and buying assets that have underperformed. This helps to ensure that your portfolio remains properly diversified and in line with your investment goals. Here are the main things we've looked at in this episode. The main focus has been diversification, of course, But there is so much to consider when investing. What investment questions can we solve for you? Just comment below. Next time, we're going back to the classroom to find out how inflation can help and hinder your investments. Make sure you don't miss it by clicking the like and subscribe button, and we'll see you next time.